It's my pleasure to be here. I know it's getting late in the day, and I'll try to keep a little energy into it to keep everybody awake. The order of the presentation, of course, was to introduce our investors first, and then I will tell you a little bit about our company. How does American Finance House tie these two fine institutions into investing and assisting us in providing the product to serve this community that is, that's for the large part, underserved. So I would like to take the opportunity and describe the model that we use for financing. I will highlight the faith basis of the model. And I do really stress the fact that we call it faith-based. It's not only Islamic. Faith-based, as we've heard throughout the morning program, we share a lot in common. It's not only Islam that cares about social justice. It's not only Islam that cares about a fair rate of return. So we like to call it a faith-based approach to financing. Next, I will explain how we apply the model that we use exactly, what are the benefits for it, how we calculate the payment. We get a lot of questions on that, and our finance officers spend a lot of time on the phone explaining exactly how do we calculate the payment. I'll also highlight the documentation that we use, and inshallah we'll conclude. What is our model? We utilize the concept of lease to purchase. In Arabic, it has a name, ijara wa iqtina', and this is really the relationship that we approach this transaction by. How does it work? Well, before I get into that, let me get into the faith basis of ijara wa iqtina'. There's two very important components we believe in: the concept about money and the concept about earning a rate of return. The concept of money can be made, totally lawful, from investment, but not from lending. Lending is a charitable activity. Investment, on the other hand, you're allowed to earn money. There is no prohibition. You can earn 5%, you can earn 20%, you can earn 100%. As long as it's from investment, there's no prohibition on how much money you can earn. Then you look at the returns. How much the limit that is fair and socially responsible and any faith would advocate. From our standpoint, the return should be based on the market value of whatever the product is that you're providing. I will be highlighting more of the home financing in this presentation, but we apply the same model for automobiles, for business equipment, etc. It has to be, our rate of return has to be tied to the market value of the asset that we're providing. In some cases, we can do better than that. By better, I don't mean higher, I mean lower than the market value. Okay, how do we apply our financing model? The model assumes that American Finance House and the client would both purchase the property jointly, and we agree to sell the client our share over a period of time. That period of time is considered the financing period in the language of our investors. In the case of refinancing, of course, we also do refinancing. The assumption here is that instead of buying from a seller of a home, we're buying from the existing lender. So what we fund is the share of the existing lender. What benefits does this model offer to a participant, a client of ours? Number one, the calculation, the payment calculation that we make is not based on a predetermined interest rate. It's rather based on the rental value of that property. So we look at it truly as an investment. If you're getting into an investment, you want to know, is this a good investment or a bad investment? How do you make that determination? It's made based on the rate of return that's generated by it. So payment calculation is based on the market rental value of the property. After we calculate the payment based on the rental value, an analysis comes in. Is this an attractive investment or not? Is it acceptable to us? Is it acceptable to you? Is it acceptable to our investors? Our monthly payment consists of two components. The first component is the repayment of the share that we put in. Obviously, you do not want to keep renting from another entity. You could be renting a home before you came to us. Your goal is home ownership. So the first section is to repurchase the share that we financed. And we call that repayment of capital, or ROFC. And we're coining some new terms, and we like to keep developing these terms so everybody can use them. So ROFC is repayment of capital that we've paid. The second component of the monthly payment is the amount that's required to compensate us for our share. A client is living in a home that has a rental value. He's only paid part of that part of that capital to live in the house. He's enjoying the full benefits of the house, yet he paid part of it. So the other party in the investment, American Finance House LARIBA, deserves a share of that rental value that the client is enjoying. So that portion that's paid to us, it's called return on capital, or we call it RONC. So we have the first component, ROFC, and the second component, RONC. Again, I repeat, we never start from a predetermined interest rate or any rate of return. We start from the rental value of the property. Looking now at the payment calculation.
How do you determine the rental value of the property?
Very good question. That's coming up.
You need to say that
That's
in
coming
great
up.
detail. Yeah.
Please be patient. The first thing I want to discuss, the first component we talked about back here was the two components. The first is the repayment of the capital. So we'll go here. The repayment of the capital is basically the amount that we financed divided by the financing period. Obviously, if you're looking to finance over 10 years, the amount that you're going to pay back is going to be higher on a monthly basis than if you're financing over 30 years. And we have a way to calculate that. It is a minimum amount, and I put that in capital for a specific reason. You can pay additional amounts. You can buy our share at any time. There's no prepayment, no predetermined period of investment that we have to be in. So this is the repayment of capital, and I'll give a numerical example a little later. Now we get to the question that Dr. Rahman was asking. How do we determine the return on capital? This is a very important issue for our clients and for our investors to understand as well. The first thing we do is determining the rental value. We as American Finance House LARIBA, our finance officers, and the client both go out and get 3 independent estimates of the rent. Each party gets their own estimates. Why do we do that? We get a lot of clients that say, I don't have the time. Brother, I trust you. Let us save time and just go ahead and calculate it and let me know what it comes out to. We really cannot approach it that way. Number one, as an investor yourself, as the client as an investor, you owe it upon yourself to know what the value of that property is. Because if I come back to you and tell you this property has a rental value of $1,000, you need to have a base to judge, am I telling you the right thing or not? It's one thing to trust me. Yes, great, I appreciate the trust. But in order to negotiate, you really need to know what that rental value is. So each of us establish a rental value from our side. We come in, we negotiate what that fair rental value is, and we agree on amount, a sum. That sum, let us say $1,000 for the sake of discussion, that sum will be allocated between us and the client. How do we allocate it? We allocate it based on the share that was financed of the purchase price or the appraised value. So if we put up 70% of the capital, the client puts 30%, we should receive 70% of that rental value initially, and the client would receive 30%. If we receive 50, if we put up 50, we get 50%. So the second item is the allocation of the rental value between the client and American Finance House. The third is the share of return that American Finance House earns will decline each month based on our share of the capital that was financed. So if we start at 80%, and each month the client is paying us what we saw in the previous slide, the repayment of capital, our share declines each month. So we don't deserve 70% of the rent every month until the end of the 30 years. If we start at 70%, the next month we'll go maybe 68, 65, 50, until we reach 0 at the end of the term. So an important item to look at is that our share declines and the client's share essentially increases. And again, we'll have questions later on that I'll be more than happy to go. Another benefit of our model, and this is really, really key, and we're probably the only company that we're aware of that does this, and that is after we calculate the payment, we've agreed on the rent, we've agreed on the allocation, we take those figures, and we have a patented computer program that we put those parameters in, and it gives us how much the monthly payment should be, that should be paid to buy back our share as well as pay us rent. And in addition to that, we take that payment, we put it into a traditional calculator that calculates the rate of return. Why do we want to calculate the rate of return? In order to determine, is this an attractive investment or a bad investment? Essentially, for the economics majors and the finance professionals, we're calculating the rate of return, the internal rate of return of the flow of monthly payments that we've calculated in the program. In order to determine, is this a good investment or a bad investment, there are three likely scenarios once we calculate the rate. Let us assume we calculate a rate and it's 8%. If that would be, say, example number one. The rate of return is significantly higher than our investors' expectations. Who are our investors? Our investors are Freddie Mac, Fannie Mae, and other individuals that we can work with, but primarily for long-term mortgages, Freddie Mac and Fannie Mae. If Freddie Mac and Fannie Mae expects 6%, and they expect 6% whether they're dealing with Bank of America, whether they're dealing with anybody else, and our rate of return on the transaction that we've agreed with the client on generates 8%, that means it's a pretty good investment, right? Because the client does not have to just pay to pay us just that 8%. He can rent the property himself to somebody else, and we're both sharing in that 8%. He gets his 30% share, we get our 70% share. So in this case, this is a very good investment. We tell the client, yes, go ahead. We will definitely finance this. Of course, by that time, we'll have checked the credit and the capacity to pay, willingness to pay, etc. But as far as the property itself, and this is also independent from the appraisal. We do a property appraisal value to check and see is the purchase price validated by the appraisal. But the most important thing of the model, is this a good investment or a bad investment? All these criteria, the willingness could be there, the capability could be there, the appraised value could be there, it could be sold for $50,000 below market, and the seller is, the buyer is very happy, this is below market. But if it doesn't pass this test, it's not going to get done. What does the test tell us? If the rate of return is above the investor's expectation, then according to the model, yes, this property should be financed. What do we do if the rate of return, like I said, say 8%, and our investors are expecting 6%? We tell the client, go ahead and do it. But not only that, we will do you one better. Instead of the rate of $1,000 that we had agreed upon, we are happy to lower the rate to say the rent to say 8% or $750 or $800, whatever amount that will bring us close to the investor's expectations. Why do we do that? In order to make whatever you pay comparable to what the conventional banks are charging, what your neighbor is paying essentially. So you're taking benefit of the model, but you're not paying a premium, if you will, to have a faith-based model or a socially responsible model. It's again, we endeavor to provide you a comparably priced model. The opposite of that case happens, which Dr. Rahman mentioned earlier, and that'll be case 2. If the rate of return, that internal rate of return that's generated, let's say is 3% or 4%, that tells us that this is not a good property to invest in. Why would you invest in a property that generates, look at it as an investment? Why would you invest in something that will only generate 3 or 4% if everybody else is expecting 6%? It doesn't make sense. So we go to the client and we tell them, I'm sorry, we cannot proceed on this transaction. This is not a good property to invest in. Now there may be ancillary reasons for the client to continue to proceed even though this is the case. There could be intangible reasons. It could be the client is looking at the long-term appreciation of the property rather than just the rental value, which we're looking at. Our investment horizon is the financing term, is the 30 years or 10 years or 20 years, whatever we agree on. I hope I'm not going too fast. I'll allow time for questions. The third option that happens, and this is really interesting, if the rate of return that's generated is just slightly below the investor's expectations, we go back to the client, we say, you know what, this property, we believe it's slightly overpriced. We believe if you go back and negotiate with your seller, and we can calculate the magnitude, if you can negotiate maybe $2,000 or $3,000 of this price, that would make this property a good investment and a proper investment. And actually, we've been successful in achieving that on a few occasions. So, again, determination, is the investment acceptable or not, is compared to the investor's expectations. Okay? Let us look at a numerical example now. This is the program that I'm referring to that calculates the fixed monthly payment. It is not based on interest. These are the parameters that I put in my program to calculate what my monthly payment should be. In this particular case, we're assuming a $150,000 price, 20% down, or $30,000. A term of financing is going to be 15 years, and we're assuming that the rental value is $1,000. And that rental value, again, is based on what was negotiated from the 3 estimates that the client provided and the 3 estimates that our finance officers provided. Putting these parameters into the program, it prints out this type of an amortization schedule, and the program basically allows us to have a level payment each month. So in this particular scenario, the client would be paying $1,147 per month, month 1, 2, 3, all the way up to 180. How does the 1,147, how is it calculated? The RONC, remember RONC, we said return on capital. I'm even getting confused. Return on capital. That is our share of the rental value. So if the client puts 20% down, that means our share 80%. So 80% of a rental value of $1,000 is $800. So the very first month, the client will pay us $800 as our share of the rent. What happens to the other $200? The client retains. It's his share. He does not need to pay it to anybody. In addition to the $800, the client will pay $347, and this is calculated by the computer in order to be able to fully repay the transaction and fully repurchase our share within the 180-month scenario. As you notice, in month 2, it will decline. Why does it decline? Because the client paid us here, already repurchased a portion of our share. We no longer have 80% equity or share of the property. So we deserve less of the rental value. And it keeps going down. If we looked at the whole 180, it will keep declining. And at the very last month, it's minuscule. The documentation that we use, I think this is important to highlight. In order to comply with federal, state, and all regulatory disclosure laws, we use standard industry-accepted documentation. And the documentation has references to interest, but the interest that's referred in there is the internal rate of return that's calculated using our model. So we use the standard documentation, and we have to disclose, actually, by Regulation Z, etc., we have to disclose what is that implied interest rate of the transaction that you're getting into for truth in lending. So we do that. We use the internal rate of return. But we supplement the traditional documents by a LARIBA financing agreement. And we think this is very important in setting forth the relationship that we have with the client. What was the basis that we approached this transaction? How did we arrive at the monthly payment? And as a matter of fact, the LARIBA agreement also states the rental value that we agreed upon for the transaction. In the sake of that example, for instance, if we were drawing this agreement, it would say $1,000 rent. It would say the transaction is based on $1,000 rent, which equals the terms that are indicated in the standard note. In conclusion, and I'll allow some time for question and answer, we offer a faith-based, socially responsible model of financing. The features of it and the keys to it are the rate of return is based on the market value of the property. It is not based on a predetermined interest rate. And the model allows for assessing and advising as to the attractiveness of the investment. And this is a very key feature. And lastly, it is cost competitive with the traditional RIBA mortgages.